Most people don't realize this, but a lot of consumers, roughly 50%, don't qualify for primary financing options offered through a retailer, like a store-branded credit card. And it's not always because they have a low credit score. Sometimes it's just because lending standards are tighter than they used to be, or because that consumer has a thin credit file, which is the case for a lot of millennials these days. With secondary financing, customers get another shot at qualifying for financing help and walking out with the product they need. When you offer a secondary financing program, you recapture sales that before would have been lost to credit declines, and this benefits retailers. And you can boost the order value of those sales too. Without credit, for example, a customer might have purchased just a 32-inch TV, but now they can afford the 50-inch model. Secondary financing works just like primary financing. Customers submit an application to a lender through the retailer, and if they're approved, they gain access to financing options. These can be bank cards, lines of credit, or loans. Or sometimes they're able to participate in lease or rent-to-own programs. It's entirely up to the retailer, of course, but most retailers find it better to offer several secondary financing options. When you work with multiple lenders, your customers have more chance to qualify for financing, and you're often able to provide financing help for more consumers. Does this complicate the application process? Not always. Some retailers have consumers fill out an application for each lender. Others have consumers fill out one form and then submit that information to each lender one at a time until they receive approval. Both of these methods can be time-consuming though, and the consumer's credit can take multiple hits depending on the number of credit applications filed. To make things easier, some retailers are using third-party platforms. Consumers give their information to the retailer once, and then it's considered for a bunch of different financing offers all at once. After that, the consumer is presented with the best lending offer available to him or her. It's a much faster process, and the consumer's credit is only subject to one hit. When a secondary financing program is set up the right way, consumers' credit shouldn't suffer, and they can benefit tremendously. Secondary financing gives consumers the opportunity to make unplanned purchases, like when an appliance breaks down suddenly, which has happened to everybody, and it helps them work a large purchase into their budget by stretching the cost out over time. Most of the time, we find that secondary financing programs really improve the retailer-customer relationship. When you can work with customers on financing, they're more likely to leave the store happy. They wind up coming back to that store more often because they know they can get the financing they need. And they're likely to tell their friends about you too. For any business, that's huge.